it's time for our weekly look at what fund managers are doing and what strategists are saying. And for that, we're crossing over to Cape Town, where we're joined by Matt Brenzel from Cadiz Asset Management. Matt, a very good afternoon to you.
Good afternoon, Steve.
Well, Matt, I've been looking at your Market View newsletter for August, and you point out that by the end of August, the JSE was down marginally for the year, whereas right at the beginning of the year, the all-share was expected to have gained more than 12% from that point. So you really can't rely too much on these forecasts, can you?
You never can. It's a fact of life. I mean, it's difficult enough to forecast the weather in Cape Town for the next 24 hours, let alone what the market is going to do over the next 12 months. But you remember that in 2009, equity markets ended at a very positive, ended on a positive high. But then almost at the turn of the year, things got a lot more cautious. The risk-off trade was back in place, and investors were basically hunting for defensives, a lot of them incorporating yield. So you see things like corporate bonds, for example, and also government bonds outperforming. Things like property, if you're looking in equity areas now. And there was a very much more sort of a defensive slant to investment strategies at the beginning of the year. That said, it's been a bit of a schizophrenic walk over the last 8 months or so, with risk on, risk off, basically alternating on a monthly basis. So the kind of factors that drove the markets 2 months back were almost replicated in the current month. And if you look 1 month ahead, you can always take the view that the market performance of the previous month would be replicated in the following month.
Well, I know that the earnings outlook has deteriorated from the beginning of the year, particularly for things like banks. But do you think that just given the share price movements over the past 8 months, that we're actually seeing a derating of our market?
Yes, you have. I mean, the earnings season, certainly for the period ended June, is now over. A lot of the commodity companies have reported. Generally, the results have been in line with forecast. So we've seen fairly extensive earnings growth. Even the banks have surprised. I think First National Bank, being the cream of the crop, coming through with very strong earnings forecasts. But the markets, as we pointed out at the beginning, have been fairly flat. So you've had zero growth in the market, you've had extensive earnings growth, implying that there's a derating that's taking place.
What does that suggest to you?
I think the consensus was for the market to be up by about anything between, say, 12 and 15% for the year, driven primarily by earnings growth. That earnings growth has come through, the market hasn't followed through. So you've seen this derating taking place, and the question is really at what point does this change? As I indicated, there is a lot of uncertainty in investors' minds. Nobody knows exactly what's going to happen looking a year out or even 2 years out, because the feeling is that we're sort of in a new market, a new environment, where I think the consumer is generally a lot more cautious. Access to debt is a lot more difficult. And in that kind of environment, consumption expenditure must be under pressure. I know my wife is chomping at the bit. I've put the brakes on her spending patterns now for the last 18 months. And she's saying to me, well, when's it going to stop? You know, when can I buy the thing that I really want? And I can't really give her an answer because the psychology of the market is just not right.
Well, Matt, I feel very sorry for your wife at this stage. You talked about the bond market, and of course we have seen those record inflows into the bond market. I think 75 billion rand year to date into bonds. Do you think at some stage we're going to see that bubble burst and perhaps see some of those spill over into the equity markets and see perhaps a re-rating of some of our shares?
I think there's a very good chance of that happening. Part of the problem that we've seen in the currency markets, specifically with regard to our own currency, has been the tremendous flows that we've seen into the bond market, where international players borrow money offshore at very low and attractive rates, where monetary policy has been extensively expansionary, and then investing in the high-yielding bond market such as our own. That, I think, will stop at some stage, and that will stop once the consumer trend re-establishes itself, and potentially that there's a little bit more fear developing about inflationary pressures. And the upward movement of prices in general.
Now, of course, you do point out in your newsletter that the JSE Dividend Index has outperformed the all-share by about 12%. And a number of market commentators that we've had in the studio have been saying to us that we need to find that yield, that you should be looking at shares that do pay big dividends. Is that something you'd be following at this stage?
Yeah, I think if you look at the performance of the high dividend yielders, they've been the ones that have been carrying basically the investors and providing a little bit of support of the market. It's an interesting, the JSE Dividend Index it's a composite index compiled of 30 shares where the JSE looks at, interestingly enough, forecast dividend returns over the next 12 months. And then applying a sort of a weighting factor to each of these counters, it then produces this index. Now, whilst the index is up by 12%, it's interesting if you do a breakdown of the underlying counters within the index, it hasn't been a uniform performance all round. The big drivers over the last 8 months have been the retail counters, such as Wooltrue, Mr. Price, and I forget the third one. But against that, you've seen, and that's been a theme within the market, the retail sector has been quite buoyant. So the retail shares within this underlying index would be the ones that have been driven quite hard. Against that, though, interestingly enough, you've seen some detractors. So, for example, a share like PPC, which is part of the construction index, which has been a sector that's really been hammered over the last 12 months, was one that detracted from the overall performance of the index. I think the thing that it does sort of underline, however, is that if you're looking to build a portfolio, build a diversified portfolio.
Well, what do you think about resources at this stage? Because we had Eleni, of course, earlier talking about some of those commodity prices, copper price looking pretty firm, gold price at record all-time highs, and yet we haven't seen the resource stocks on the JSE reflecting that really. In fact, they have been lagging the general market. Do you think they're going to play a bit of catch-up at some stage?
Yeah, again, I think the market doesn't believe what it's seeing. There's still concern that the developed economies are going to underperform, that the Chinese government might overshoot in terms of its tight policy, and that as a result, commodity prices might come under pressure. I tend to take a slightly contrarian view in that regard because I just look at the supply and demand fundamentals, and the supply, as far as commodities are concerned, hasn't picked up. So at some stage, if we do get a kind of a rebalance towards growth, and it becomes a synchronized growth where we have both emerging markets and developed markets moving upwards on a positive trend, with a lack of that supply side response coming from the commodity producers, it can only imply that pricing pressure is going to appear. So I must admit, I am a commodities bull from a price perspective, commodities price perspective. I think that will be reflected in the commodity share prices at some stage in the future. What the trigger is going to be, I'm not exactly quite sure. Probably, as I said, a resumption of sort of unified growth patterns in economic growth of the rest of the world.
Where else would you be seeing opportunities in the market at this stage? And what do you see as some of the risks? I know that the Fed is meeting next Tuesday. There is talk about QE2, that's the second wave of quantitative easing. Would that be a risk? How would you be positioning yourself in a market like this?
Well, if there's a resumption of QE2, then I think that's a net positive because it implies that the Fed is concerned about growth and growth prospects within the US, and it wants to make sure that certainly the slowing trajectory that we've seen coming out of the US will not exacerbate on the downside. I think that overall, from a commodities perspective, there's value in certain areas. If you just look at the performance of the platinum shares, for example, one of the leading underperformers of the JSE for the last 8 months, that's an area that I would look at. I would look at other areas of underperformance. I mentioned PPC a little bit earlier. The construction stocks have been land-based. I think here and there are some interesting value opportunities. Aveng is one of those, company that's got a fairly extensive order book, fairly high cash reserves, very sound balance sheet. It's geographically diversified. It holds all the elements of the things that we believe offer value. And plus, the big factor is that the investment community has kind of turned its back on it. Those are the ideal kind of opportunities we believe that you should be looking to pick up at this stage.